Welcome to New Money. I'm Bryan Hurst. This evening we are focusing on the investment world. After a disastrous 2022 in equity markets, the recovery 2023, which has continued in the first quarter of 2024, investors need to understand that they need to maintain a long-term outlook, particularly during market downturns. The two asset classes, namely property and equities, that create long-term wealth are seen so differently. Everyone understands that property is a long-term investment, and while the same does apply to equities, unfortunately, because one can value equity components so regularly, it often creates investor uncertainty. What is important is to make sound decisions despite emotional ups and downs. And joining this evening in the Zoo Room from Cape Town is my regular guest, Henry Biddlecombe, investment analyst at Anchor Capital. And I'm absolutely thrilled to welcome back Paul Hanson, lifelong student of investing, who shared this panel with me for over 15 years before his retirement. Paul's in the Zoom room from George. As a matter of fact, you can see how relaxed Paul is. That's what retirement does. Henry, Paul, lovely to have you both on the show.
Hi, Bryan.
Thanks, Paul.
Paul, my first question to you, when you were a fund manager, it was a lot easier because you spoke about long-term, you spoke about the long-term performance of funds. Now you're investing funds for yourself, many friends and family members. And now you're involved in questioning on a daily, weekly, monthly basis how my funds have done, are they performing? How are you dealing with this change of the psychology of investing from being very, very passive to active?
Yeah, look, it's just a question of the same old story: buy low, sell high, not the other way around. And try and stick to that. Listen to Warren Buffett's wise words of not losing being the most important thing. So it's the same story, just although the South African market has been very difficult, it's still following that situation where you try and buy low and sell high. But I mean, the story in our market has been that the long term has fallen away a bit, in the sense that you used to be able to buy good quality shares and hold long term and end up doing very well. These days, it's become a little bit more of a trading market. You see the long term still working in the US with a lot of the tech and other shares that have done very well over a long period. But here, it's become a bit more of a trading market. And that's probably because of the circumstances and the country and the economy and everything.
Yeah, because Paul, if you look at our markets and you backtrack it 10 years and you compare it to dollars, I mean, although we earn so much money offshore, all these different companies, I think 81% of South African companies earn more than 75% of their income. It hasn't translated into market performance.
No, it hasn't. I mean, obviously you get occasional share like Richemont and the commodity shares when the commodities are doing well. But otherwise, yeah, the shares haven't done that well, the Rand hedge shares. I mean, you look at Sasol, and Sasol right now is down at over 70% from 10 years ago, even though today it's up about close to 6%. It's still down 70% from 10 years ago. And so a lot of our shares are trading at levels of 10 years ago. A lot of the banks and others, the good old Foschini, Woolies, Truworths, they're lower than they were 10 years ago. So it hasn't worked as well, the Rand shed story.
Henry, to bring you in on this situation, the last program you and I had, and maybe even the previous program towards the end of last year, you were rather cautious on markets. And I just wondered if you're feeling any more positive about markets, or you still got that same cautious stance.
No, Bryan, I think I'm still cautious, even more so now. At the time, the market was, 6 or 7% lower than it is today, and the same factors are at play. I think what is interesting, though, is if you're watching the kind of global risk-free asset, the US 10-year Treasury bond, the yield's been ticking up over the last kind of 30 days, and in fact, over the last 3 months. And that's starting to tell you that the market is starting to think about higher rates for longer, and with the S&P trading at sort of 21 or 22 times forward earnings, I'm a little worried about equities at this point.
Yeah. Henry, when you talk about higher rates, are you talking rates higher than where we are now, or just rates staying high for a longer period?
No, so if you go back 12 months, or at least even 6 months, or even 3 months, the market was pricing in, 4 or 5 cuts, and now we're down to 2 or 3 this year. So it's more a case of the market anticipating that rates stay where they are now for longer.
So you don't see rates in the US moving up and rates in South Africa actually moving up?
Look, I think the right way to couch it is that I think there's a higher risk now that rates stay where they are than there was 6 months ago. And I don't think that's a scenario that equity markets are discounting. So you're starting to see clues come through in the bond market, but it doesn't yet reflect in equities. And if it did, I think that, for example, the US market would need to be 10 to 15% lower than it is today.
Paul, you've been involved in global markets for years, but what are they telling us? Henry's quite cautious. Do you feel? I mean, over the years, I can remember many years, both on radio and television, you being an absolute global bull. Where are you? Where are you in this position at the moment? What are global markets telling us, especially the developed markets?
Well, yes, I'm still in that position. Actually, if you look at the US market, you look at the Japanese market, it's a record, finally broke through to a record high after, I don't know, 30 odd years. 1989, I think, was when it peaked. And just in the last few months, it's broken out of that from its previous record high. So it took a long time. But if you look at the US markets, they are certainly in a strong uptrend. They're in a bull market, and it's been going for 5 months now. So this would be into the 6th month, although this could be a down month by the looks. I mean, it does look like it's getting a bit tired. It's had an incredible run. I mean, it's way exceeded, I think, any expectations. And we haven't seen the small shares join yet, the small stocks in the US, probably because of the interest rate story that Henry was talking about, that they were hoping for cuts, and now maybe there won't be any cuts. Who knows? There could even be a hike. But this interest rate story is affecting the small shares. But the economy has remained much more resilient and stronger than anyone expected. And I mean, the employment figures, the unemployment, unbelievable at the moment. It's much stronger than expected.
Henry, let's talk about something that's very good for South Africa. Can you explain the record gold price and how should we be interpreting this?
Yes, if you look at gold, it's kind of a risk-off trade. Some portfolio managers refer to it as a risk hedge. And I think that's kind of what you're seeing playing out right now. I think there's increasing concern around the sustainability of the rally in the US. So, gold is typically a place where fund managers will rotate. And on top of that, I think there's a little bit of a central bank accumulation trade as well. Just interestingly, looking at the gold producers, though, those don't necessarily reflect the rally in the spot gold price as yet. So that's perhaps a pocket of opportunity if you think that the gold price is going to stay here. So we've been buyers of the gold producers rather than gold itself. But the gold stocks are telling you that people don't expect the gold price to stay where it is.
Yeah, because I mean, nearly every day it reaches a new high. I mean, I think it's over 2,300 at the moment.
Yeah, I don't think it's I don't think it's a bad place to be, but I'd rather buy the gold producers than gold itself at this point, just given the lag.
Okay, so then, Paul, the million-dollar question, is there any hope for our beleaguered rand?
There does seem to be a little bit of hope, because lately the euro has weakened against the dollar, and yet the rand has strengthened against both. So that's quite unusual. And we are still undervalued. We have been undervalued for a long time. And there seems to be a possible turn in commodity prices. And we're still a commodity currency. Obviously the gold price pumping, but we don't produce that much gold anymore. But we're seeing copper and other commodities. We've seen iron ore pick up a few percent today. So there is a hope that China could be firming a little, and that the commodity prices could be turning in the upward direction, which would be good for the rand, and also help emerging markets. So you may see emerging market currencies, commodity currencies, starting to firm against even the strong dollar. It's potentially building up for that. We could, who knows, in 6 months we could be into the 17s. I mean, it's possible.
Every month, the government retail bonds that is available to retail investors show you a 5-year performance. And up to last month, the rate that they were giving for 5 years is 10%. This morning I noticed the rate is 11.25, which is a big jump in the month of March. But Henry, let's just come back. You spoke about treasuries in the UK. So our bond market has really weakened in the last six weeks. And what has caused this? I mean, do you currently see any value in government bonds?
Yeah, look, I think sometimes we make the mistake of trying to isolate what's happening in South Africa, where in fact the South African market, whether you're referring to shares or bonds, is a little bit of a cork in the ocean, really. And we just get blown around by the currents. And I think that's what's happening in our bond market at this point in time. So again, looking at the US 10-year Treasury, the yield there has gone from 4% to what, 4.4% today over the last kind of 3 months. And our bonds have traded down in sympathy with that. At the end of the day, the fixed income markets are inexorably linked. So I think it's just US yields carrying our yields higher, really.
Well, I'm going to put a question because I've got an email that I want to deal with when we come back to this. Paul, I'm going to give you a question. I'm not sure if you're following the proposed two-pot system in the retirement funds. Old Mutual have estimated that approximately 1 million South Africans in employment are going to withdraw funds after the 1st of September in the system. Paul, have you been following this at all?
Yes. And obviously it's going to help people in the short term, but the long-term retirement, not too good.
Yeah, because people don't realize that the money they take out now, particularly over 20 or 30 years, the compounding effect, the eighth wonder of the world, being compound interest, I mean, has a major impact of that. But we'll come back to that. We're going to take a short break now. Stay tuned. We'll be back shortly.